Towards a brighter financial future, with India being perceived as the fastest-growing major economy in the world, it has become a promising destination for investments. The country's growing economy, coupled with the increasing wealth creation opportunities, is attracting a significant number of non-resident Indians, NRIs, to invest their savings in the country. As NRIs look for ways to diversify their portfolios and maximize their returns, mutual funds have emerged as an attractive investment option. With their relatively low cost and diversified investment portfolios, mutual funds have become a popular choice among NRIs seeking to invest in India. Popular investment options for NRIs: equity-oriented mutual funds, debt-oriented mutual funds, hybrid mutual funds, index funds. These mutual fund types cater to different investment objectives and risk preferences, making them an excellent choice for NRIs with varying investment goals. Taxes, a crucial aspect of NRI investments. For NRIs, taxes are a significant concern when it comes to investing in mutual funds. The tax implications of investing in mutual funds depend on the type of scheme, the holding period, and the type of mutual fund, equity or debt. Here's a breakdown of the capital gain tax treatment for mutual fund investments. Short-term capital gain, STCG, on equity-oriented mutual funds, units held for less than 12 months taxed at 20% non-equity. Debt-oriented mutual funds taxed at the investor's income tax slab, as per the marginal rate of taxation. Long-term capital gain, LTCG, on equity-oriented mutual funds, units held for 12 months or more taxed at 12.5% in addition to the capital gain tax. NRIs are also subject to tax deduction at source, TDS, at the time of redemption. The TDS rates for equity-oriented funds for STCG earned by NRIs are 20%, while for LTCG, the TDS rate is 12.5%. For debt-oriented funds, the TDS rate is 30%. Double Taxation Avoidance Agreements, DTAAs. India has signed DTAAs with around 90 countries to prevent double taxation on incomes arising in one country to a tax resident of another nation. Under these agreements, NRIs can claim tax credits in India on the earnings from their mutual fund units, provided India has signed such an agreement with the resident country of the investor. This means that NRIs can enjoy tax-free realized capital gains on their mutual fund investments, provided they have the necessary tax residency certificate. The recent IDIT judgment, a boost to NRI investments. In a recent judgment, the Mumbai Income Tax Appellate Tribunal, IDIT, ruled that capital gains earned from Indian mutual fund units by NRIs will not be taxed in India. The decision was based on the India-Singapore Double Taxation Avoidance Agreement, DTAA. The judgment applied to Ms. Anushka Sanjay Shah, a Singapore-based NRI who earned 1.35 rupees crore in short-term capital gains from the sale of equity and debt mutual fund units during the assessment year 2022-23. The assessing officer, AO, had initially treated mutual funds units equivalent to shares in Indian companies and taxed the entire amount. The IDIT distinguished between mutual fund units and shares, stating that mutual funds are created as trusts and not companies under the Securities and Exchange Board of India, SEBI, regulations. The term share is not defined in the DTAA, and mutual funds units are not treated as shares under the Companies Act. This judgment is expected to have a positive impact on NRI investments in India, as it makes capital gains from mutual fund investments tax-exempt for NRIs. The impact of the IDIT judgment on NRI investments. The recent judgment of the IDIT makes capital gains from mutual fund investment tax-exempt for NRIs. It will not only benefit NRIs in Singapore but could also have a positive impact on non-residents investing in mutual funds in India where the DTAAs are in place, such as Mauritius, Hong Kong, UAE, Portugal, Australia, France, UK, Germany, and many others. NRIs may be encouraged to invest in India, leading to higher inflows into mutual funds and a boost to the Indian mutual fund industry's assets under management. To take advantage of the tax-free realized capital gains, NRIs should have their tax residency certificate, TRC. It's essential to note that the TRC for the domestic law should not be confused with the one available for the DTAA benefit. In conclusion, The recent IDIT judgment is a significant development in the world of NRI investments in India's mutual funds. It makes capital gains from mutual fund investments tax-exempt for NRIs, providing a new opportunity for investors to grow their wealth in India. A word of caution: while the recent judgment is a positive development, NRIs should be cautious when investing in mutual funds in India. It's essential to understand the tax implications, the terms and conditions of the DTAAs, and the requirements for tax residency certificates. NRIs should also be mindful of the different types of mutual funds available, their investment objectives, and their risk profiles. It's recommended to consult with a financial advisor or a tax expert to ensure that NRIs make informed investment decisions. By doing so, NRIs can make the most of the opportunities available in the Indian mutual fund market and achieve their financial goals.